right, we're going to go and get started. So this is Alan Badger with Goosehead Insurance. He is brother to Kevin, who is with Brooks Company, and their sister's married to Brooks. And they live like pretty close to each other. So it's kind of cool if they live closer, do stuff together. So, you know, I don't have that kind of family. I'd love to, but anyways, I trust my own home insurance, my cars. That's not the reason to use him. The reason to use him is because he is available to search everything. So he's an insurance broker, means he really doesn't own any, but he's able to search just like a mortgage broker like Brooks. So I asked him to talk today because these Fridays at noon, because we do so much training, I thought the noons could be specific type of a trade in our industry that we get affected by, and that a buyer easily could ask you, how is insurance done? And, you know, so he has a presentation, the screen's here, we're recording it. And if you're online, or, you know, if nobody's dialed in yet, I'm not going to stop to come and accept them, but it'll be recorded. So the floor is yours. And he's down in Dallas by White Rock Lake.
Yep.
So, all right, Alan Badger.
Well, good afternoon, everybody. Like Doug said, my name's Alan Badger, and I'm an independent broker with Goosehead Insurance and DFS Advisors. Two different companies, but really the Goosehead portion of my side is we do personal insurance like homeowners, auto, and then the DF side is we do commercial insurance. So I kind of wear two hats here with two different companies. But for today's purpose, really just going to focus on homeowners insurance because that's what you all are going to be dealing with more. And so we'll go with that and kind of the Goosehead side. Before I get into the presentation, I first want to kind of give you a brief introduction of who I am. I am brother of Kevin, but I am the good looking one. So that's first and foremost. But I am from Dallas. I graduated Lake Highlands High School in 1998. And then I went to Texas Tech University where I got a degree in restaurant, hotel, institutional management. After college, I worked in several different states in New Mexico, Oregon, worked down in Austin, ending my career with Marriott, usually focusing on the hotel side, working with Marriott as a director of sales. In 2015, I got an opportunity to switch careers into insurance, which I've really been enjoying because I get most of my weekends back now and almost all holidays. If anybody's ever worked in the hospitality industry, you know that's a rarity. You don't get to do it. So, but I've really been enjoying switching to insurance, and really I've gotten to take the customer service experience I've learned in the hospitality industry and transfer that over into insurance. So I can give clients a really good customer experience, but also I get to keep taking care of people, what I usually did in hotels. You know, when people came to hotels, they were either traveling for business or on vacation. So I was there to take care of them. But now in insurance, I still get to take care of people, but what I'm doing is protecting them and protecting their biggest asset, which is a home purchase. So enough about me. Let's kind of get into the weird, wild world of insurance, which honestly, it's not weird. It's not wild. It can be boring at times, but it is very important, and especially with what you guys are doing. You're going to start with a contract. You're going to look at the lenders, and inevitably, it's going to typically end with insurance. One of the last things you need to do before a deal is closed. So, kind of jumping in, who can tell me what their description of insurance is?
Covering the house from damages, or
yeah, it's I know it's a pretty simple idea, but yes, and you're correct. The technical kind of term is measuring risk and then protecting against that risk. And as we go through it, I'm going to go through a whole bunch of slides here. It may be too much information, but I think the more information y'all have, the better realtors you'll be, and the better realtors you'll be to your clients, and a more efficient closing. So let's just go right here. Is this okay? So the first screen, can y'all see that? Is that big enough? Let's see if I can. Do you know how to get to the? Let's see here. I do it. I was hoping to get into the slide. Mine.
Go to Scotch right to the top right.
Right there?
Top right.
Oh, there it is. There you guys. Yeah, see, it's teamwork right there. Okay. There we go. So there we go. That's what we're looking for. So this list of items here are what are going to be listed on a standard homeowner's policy. The first thing that we're always going to look at is the dwelling coverage or the dwelling reconstruction cost. How much is it going to cost if your home were to burn to the ground? How much is it going to cost to rebuild the home? Then everything is typically a percentage off of that amount of that dwelling coverage on an insurance policy. Going from there, you have your personal property. If you were to take the home, shake it up, turn it upside down, everything that falls out of that home is going to be considered your personal property. Now, there's going to be a specific limit of what covers that, but if you have specific items like jewelry, like a wedding ring or golf clubs or firearms, you're going to want to look at scheduling that. But for the general purposes, everything that falls out of your home is going to be personal property included on a home policy. Next one is going to be other structures. This is pretty much going to be your fence line. If you have a shed in the back, or if you have any kind of structures that are not attached to the home, like a detached garage, that's going to be more of other structures. Loss of use. If, let's say, that fire burnt the home to the ground and you had to go live at a hotel for a little while, loss of use coverage is going to be covering your housing, your food. So there's a lot of aspects to the home policy than just covering the home. Another one would be personal liability. This is an important one. This limit comes in increments of usually 100, 300, and 500,000. When you're looking at personal liability, this can kick into effect when, let's say, somebody comes to your home, you have a pool and gets injured in your pool. Well, they're going to try to probably sue you for that, these days. So liability will kick in to protect you. What a lot of people don't know is on a homeowner insurance policy, if, let's say, you're in an auto accident and you were at fault and you caused either injury or death, kind of that same scenario is going to happen, a lawsuit's coming, they're going to probably max out your auto limit coverages. If that ever happens, your home policy can kick in with that liability coverage. So it kind of can bridge over into the world of if there's a lawsuit going against you and pending on what it was, like the auto scenario I gave you, it could kick in. So it is a very important coverage that not a lot of people think about when they're looking at home insurance, but it is included. Same with medical payments. That's a pretty easy one. If somebody trips and breaks an ankle at your house and you want to help with their medical payments, you have coverage there. So that was a real quick, brief explanation of all these coverages. This is what's going to be included on a homeowner's policy. This is the very basic homeowner's policy that includes all of these items. I wanted to kind of give you guys a template I use to kind of show you what the quote will look like. This is what I like to send out to clients just to give them, hey, here's a basic option, and then right next to it, here's a recommended option. And as you can see in the first part, in the first top section here, you're going to see the dwelling reconstruction costs, other structures, personal liability or personal property, personal liability, everything we just mentioned. Before we go down to the policy options and endorsements, right above that, you're going to see deductibles. You'll see all other peril, wind and hail. Just keep that in the back of your mind. We're going to go over that on a later slide, but it is very important. When you're looking at the second section, the policy options endorsements, these things are not included on a homeowner's policy. So they're going to be coverages like I explained. We're going to explain later, but just note that you can get a basic option, get the lowest rate, but then there's going to be recommendations. So there's a lot of information and coverages we can go through. What are you really protected from? And I love this picture. I don't know how this happens. I don't know if this was an auto or a home claim or a tornado sent a house into the roof. I don't know, but it always gets everybody like, okay, this is why you want home insurance, because how does that get covered? Well, there's, and to kind of segue into that, there's a lot of different homeowners policies out there. I'm briefly going to go over two of them, the HOA and HOA Plus. with our company, we don't recommend these policies. They can get you a rate and they can get you coverage, but it's not very good coverage. And it can really put you or your client in a pickle if they thought, hey, I have homeowners insurance, everything's covered under this. And then they find out, no, actually it's not covered. And then all of a sudden they're having to pay thousands out of pocket to fix it. And we'll go a little bit into detail. First, the HOA policy, homeowners one. You're probably going to get a very low rate on this policy, but you're also going to get a lot of low coverage. For example, on an HOA policy, you're pretty much just going to be covered for fire, lightning, wind, explosion, I guess, with the gas leaks these days, if you heard explosion, but smoke, vehicles, but really you're not seeing much water damage. And that's going to be a common claim in homeowners insurance is water damage. For example, you don't see freezing on this listed. So if everybody remembers the winter storm we had, electric power went out, pipes started freezing, pipes started breaking. Right.
Yeah.
And if you, yeah, is that a little nightmare? It brings nightmares. Well, if you had a home and you were on an HOA policy, guess what? You weren't covered for that, and you're going to have to pay that out of pocket. Now, you might be quoted a homeowner A policy and think, hey, I have homeowners insurance. This would obviously be covered. No, it's not. So you got to be very careful of what we're looking at when we're talking about insurance. The HOA plus, it's also known as an HO2 policy. It's just one level higher than an HOA. And you're going to see they add on several more perils to what's being covered. So you do see the freezing now. You do see the accidental and sudden cracking, bulging of pipes. Sudden and accidental. If the pipe were to break and cause water damage, you would have coverage. But it's still not quite there. It's still not a great policy. It's better, but it's not great because, and as you'll see, it says named perils. On a named peril policy like this, it has to, the cause of damage has to be one of these, has to be able to get coverage. On the next two policies I'm going to show, we'll just move right into them. The homeowners 3 and homeowners B policy. Those are considered more open peril policy. And the HO3 is the one we usually work with. It's the more common policy across the country. And to kind of give you an idea, well, the HOB, we'll go to that one real quick. The HOB is going to be your kind of cap of insurance policies. It's going to cover almost everything under the sun. So the HO3 and the HOB policies are where you kind of want to land in when you're looking at insurance. Now, the difference between an HO3, HOB, and the HOAs I was mentioning earlier is that you're covered for everything except these. So it's different. It's a little technical, and I don't want to hang out on it too long to confuse anybody. But in a sense of the HOA and HOA plus policies, it has to be listed for you to get coverage. Here, everything's covered except war or well, it says water damage. Those are included, and we'll get into that a little later, but nuclear hazard, things like that. Things you're like, okay, what are we talking about here? Yeah, exactly. We got bigger issues if we get hit by a nuclear bomb than your homeowner's insurance. So
intentional,
meaning fraud. You strike a match and throw it on your couch to start a fire to cause your house to burn down. So those won't be covered on any insurance, but that's specifically listed here. So an HO3 and an HOB policy is going to give insurance carriers less room to fight back to pay a claim, whereas your HOA and HOA plus, it has to be one of those, and if it's not, they can push back and not cover the claim. So I just wanted to give you kind of a list there, because what I've seen when working with clients and realtors, you always hear, I want the lowest rate, lowest rate, lowest rate, lowest rate. It's like, yeah, I get you. But at the same time, if you get a bad policy, you could be paying thousands out of pocket instead of having coverage
for your client.
Exactly. And I'll get into it and kind of explain more why that matters too. But Yeah, you had a question?
What's an example of like price difference? I know it's
Every scenario is different, and we're gonna get to there's a little pricing section, but no, that's fine. But it's a great question. I've seen an HOA plus, I don't really see HOA policies anymore. I know they're out there, but nobody really uses them. But an HOA plus versus an HO3, I've seen $300 to $400 difference for the year. So you're not talking a lot of money when you break it down monthly versus the coverage you're getting. So, and what's tricky that I see is that clients and realtors and lenders too don't know this. They don't know they just see homeowners policy and they're good to go. Where I look at it, I'm like, yikes, let's dig deep into this to make sure we're actually providing proper coverage.
So before you move on,
Sure.
you said you didn't go into number 3, a little bit more, water damage. Line item.
Yeah, well, there's gonna be a section here of water damage.
Okay.
Accidental and sudden is included. There are 3 additional water coverages that we'll get to that are not included, and that's going to be on my recommended option. So you'll see the basic, and then you'll see the recommended. Okay, and this is just more excluded perils. One's a big one is wear and tear. Wear and tear. If the home is just aging and wear and tear happens to the home, you're not going to be covered. That's something you have, as a homeowner, have to take ownership into. Rates versus coverages. So we were talking about, rates, low rates versus proper coverages, and what that means. Factors that could affect your home prices. Now, before I get into the list, what we're seeing in the North Texas area is a general spike in rates across the board. And no, that's fine. Yeah, I know.
My car insurance premium just went up and I had no accident.
No claims, no nothing. It's just a general.
It went up $15.
Yeah. Well, unfortunately, kind of what we're seeing, or what we've seen the last couple of years, specifically to home insurance, is when the pandemic hit and there was the wood shortage, that raised the prices on wood. Well, if your house burned down and you had to rebuild, you had to go with the wood that they had, and so everything had to be recalculated. As we keep moving into items being more expensive, that's causing the replacement cost, that coverage A, dwelling reconstruction cost. They're having to recalculate that to cover the prices in the building material. And so when we increase that, you're increasing the rate. And so everybody across the board, we're just seeing this general rate increase. The good news for the Dallas area is we're not Houston. Houston is way more expensive. I have a couple of clients in Houston, and they're way more expensive, probably about $1,000 to $2,000 more than what we have here. And that's typically due to hurricanes. We don't get them up here, they do. So that's kind of part of that risk factor that they're measuring.
They get more floods.
They get more floods. They get more, and we'll get into flood because that's different than a homeowner's policy.
A lot of people learn that too.
Yeah, and unfortunately, a lot of people, what y'all are getting here is crash course in insurance. A lot of people don't learn this until they have a claim and they're like, sorry, we're not covering that. And then that's when they get irate, and then they really start wanting to know what insurance is. So when you have a client that's a new home buyer, this is just as important as everything else you're explaining. This is going to be an important one as well. Now, this is where you refer it over to me, and I can take the reins for you so you don't have to. And we'll get into that a little bit later too. But some factors that could affect your premium, your home's age and condition. I bought a home in 2019. It was built in the 50s. It's a 72-year-old home. It has been updated, but some homes out there haven't. So when insurance carriers are looking at it, like, well, that's a 72-year-old home, we're probably going to have a pretty high risk of something breaking and having us to use insurance. So that can affect rate. The replacement cost, what I mentioned of having to increase that replacement cost, is going to increase the rate. Construction materials. Do you have carpet and tile versus granite versus the countertops? These are all kind of factors that when we're calculating the replacement cost, I look into. I go to sites like Zillow and Trulia to get pictures on the home so I can get my eyeballs on it to see what is actually in the home. And then I like to cross-reference that with the county appraisal just to see where they're landing. and we'll get into that too, because that's just important. We got a lot coming down the line here. So where you live. So here in Dallas or Plano or in the Metroplex, usually you're going to have pretty lower standard rates compared to somebody that lives out in the rural area that's 10 miles away from your closest fire department. You know, that's going to be a factor if it takes time for the fire crews to get out there to put out the fire. And that's where you start learning about protection classes. So typically on a home out in the rural areas that has a volunteer fire department, you're going to see an increase in rates there. Claims history. Do you file a lot of claims? How much insurance do you use? Do you use it all the time? Is there every year you file a claim? That will be a factor. That's a big factor. And I know you wanted to talk about the clue reports, Doug. So I don't know how y'all are familiar with the clue reports, but none at all. Okay. Okay. So the clue report, and it's I don't know what the breakdown is, acronym, but it's CLUE. And whenever I run quotes, we're going to run a clue report, and pretty much it's the history on the home within the last 5 years. If it's gone past 5 years, nothing really pops up. But if there was a fire or there was a water claim or any kind of claim that's happened in the last 5 years, a clue report is going to show that. Now, I've done it in the past where I've worked with realtors going, hey, can you run a clue report? And yes, I can, but it takes a lot of time to do that. So we really don't want to run one until we're actually in the process of quoting. They're under contract and recording. So, and I'll just interrupt here real quick on that. The best time to start looking for insurance is whenever you go under contract. You want to get this done right away because there's that option period that, oh my gosh, we found a water claim that just spiked insurance up, a couple thousand. Maybe they want to stay in it. Maybe they don't. Maybe maybe they want to take on that risk. Maybe they don't, but it's just information for them that you're providing through the insurance. So really, whenever it comes under contract, you're saying, hey, what's up?
Happy birthday,
Hey.
Ryan.
Is it happy birthday? So
Those cookies are just for you.
these are Ryan's cookies. But that's what a clue report is. It's going to show you the history on the home, and that's really important for buyers.
That goes back 5 years.
It goes back about 5 years. It could be 6, but typically it's about 5 years. And I've seen clue reports sink deals where they've waited too long, and we're like a day or two before closing, and they finally reach out to me to get insurance. I run the clue report. All of a sudden, can't find insurance, or it's way too much for Ryan to close on, and the deal falls apart. And that was all based on insurance, and we could have avoided that if it started right away, right as it got under contract. So that's something that really for you guys would be.
What about new builds?
So new builds, you're gonna have a clue report, but it's not gonna find anything. And really, that's even trickier because you're not gonna find anything on Trulia, Zillow. You're not gonna find anything on the county appraisal. So that's really me talking to the client, getting all the specs on the home, square footage, number of bathrooms, type of flooring, this and that. What's good on a new home is you're probably, for the first year or two, you're going to have warranty on that home. So, a little less easy, but once it turns year 3, that warranty is gone, and you're really going to need to focus on insurance because, things can start happening. Even if it's 3 years old, something could happen that
When they start happening.
it's when they can start happening and everything like that. Finally, credit score. So when we run insurance, and this goes with everybody, usually they're not told this. We try to tell our clients that we work with, they're going to run a soft hit on your credit. It's not a hard hit, and it's not going to affect anything for Ryan's closing. But what it does is it's a soft hit, but it acquires your insurance score. We like to ask for the social, but it is optional. If we don't get the social, it's going to be based off your date of birth, which is not very accurate and can lead to off numbers. So just another factor that can lead to higher rates if you got a low credit score. And then age of roof. This, I can't explain it enough. This is one of the biggest factors in home rates in North Texas. It's one of my first questions I ask a client: how old is your roof? Because it's one of the leading costs. Typically in insurance, carriers will look at a roof that's about 15 years old as an old roof. And 15 years and plus, they will start restricting coverage or canceling coverage or restricting it to a point where they move it to an actual cash basis where they add depreciation to it and it's not replacement cost. So one of the first, like I said, one of the first questions I asked, if they have a brand new roof, we're going to look good on rates. Things are really going to look good. If you're a roof that's 13, 14 years old, they're going to increase the rates because they know that roof is coming up to be replaced and they're going to be on the hook for replacing it, which can range from $15,000 to $20,000 depending on how big the home is and how much roof space there are. So something you guys can, if you got a buyer, you can help your buyers by trying to find out that information of how old's that roof. If you're a seller and you've got an old roof, maybe you want to look into getting a roofer to come out and replace that roof because it might help sweeten the deal for the sale because it could bring the insurance rates down. And one thing to note with roof coverage on insurance, it's considered an act of God. So you file that claim, it's not going to work against you. There's nothing you can do to prevent a hailstorm from hitting your roof and causing damage. So in those types of situations, we've seen, where the seller and the buyer are going back and forth, and then, hey, we'll replace the roof, we'll file a claim, doesn't charge against the client. Next thing you know, closed deal kind of situation. So roofs are important. Another important factor is market value, market land value versus coverage versus the loan amount. So when I'm looking at quotes and I get, Ryan sends me a deal, I'm looking strictly at the dwelling amount. How much? Just the dwelling, not the land value or the market value. If the home were to burn down, how much is it going to cost to rebuild? That's strictly what insurance is looking for. I've seen situations where lenders or realtors go, well, I need the loan amount covered. Well, the loan amount's going to factor in market value and land value, which is going to, and if that's the case, then they're including that into the insurance, which is going to keep your rates higher. I don't like doing that because it's not accurate. That's where I go to the county appraisal and they'll break out, they'll have the dwelling value and the land value. I go to the land value and I can take that number right off. Then I run what's called a replacement cost estimation to show Ryan and his team, hey, this is what the dwelling is costing, not the land value, the market value. So that's sometimes where people get tripped up. It's like, well, that's not enough insurance. I'm like, well, yes, it is. And here's an example. If you're in let's say a wealthier neighborhood, Highland Park, for example, or Preston Hollow, those homes could have been built in the 40s and 50s, but the land value is like $1 million. But that home was built in the 50s and probably cost, if it's 1,700 square feet, probably costs, I don't know, it's $200,000 to replace, if that. So I'm not going to insure this home that costs, $200,000 to replace 1.2 million. That's where it gets different, and that's where people get tripped up. So that's just kind of another deal to kind of keep your eye on. And county appraisals, it's public information. You can go, and I'm sure y'all are full aware of this. You can go on there and take a look and see who the homeowners are and everything about it. Another one, replacement cost versus actual cash value. With Goosehead, we only look at replacement cost alone, 100% replacement cost. Whatever I calculate for that replacement cost estimation, that is the number I'm going with. There are agents out there that will insure 80% of that 100% just to get a lower rate. But the problem is whenever there's a claim and they're trying to replace the roof or replace fire damage, they're only going to pay out 80% of that damage cost. So it just, and all you're doing is causing more headaches for a client or for yourself, if that's the way you choose it. Actual cash value is an option too, to keep rates low. Even if they went with 100% replacement cost, they could attach actual cash value, which they'll look at the home and go, well, this home was built 15 years ago, so I'm going to add 15 years of depreciation to any payout I give you. So there's a lot of tricks and a lot of weird things that can happen to keep rates low, but it's also not providing you good coverage. Now, this replacement cost and actual cash value, can apply to your roof. So that's another one. You can have your home at 100%, but specifically make your roof actual cash value, which we don't recommend, because if you have a roof claim and you need to replace your roof, you want 100% of that roof replaced, not 20% of it. And then I'm ponying up for 80% of that roof claim. So there's just things to kind of look out for. Hail and windstorms. North Texas, #1 claim. Hail and wind damage. That's why that roof comes in and is so important. With that, you're going to go back to those deductibles. So you saw when we were looking at that form earlier, you had all other perils, and then you had wind, hail. Your all other perils are going to be fire, lightning, smoke, everything that's not wind, hail. Why they separate it here is because it's so common now, or at least this in the state of Texas, they separate it. What I'm seeing now, I'm seeing agents and some carriers putting a minimum 2% wind hail deductible on there. We don't recommend that, because when it comes time to, and it will come time to replace your roof, you want as much money from the insurance company as possible to replace that roof. Now, that's at the minimum, that's 1%. So if we had a $300,000 home and we had 1% deductible, that's $3,000. That would be the deductible. If they tack on 2%, 6,000, and up and up and up. So, and kind of basic math, let's say your roof was $15,000 to replace. Well, with a 1% deductible, you're going to get a $12,000 check back from the insurance company to replace that roof. 2%, you're going to get $9,000. So automatically right there, just for saving a couple $100 on your annual premium, you're going to be paying twice or double the amount out of your pocket. So we don't recommend companies that do it. We can do it, but it's not a recommendation.
The 2%.
Yeah, and Progressive is one of the companies, one of the home companies that has a 2% minimum for Dallas, Collin, Tarrant counties. There's a few others. So, and once again, if you're not paying attention, or your client's not paying attention to this, this is something that can just go under the radar and won't be noticed until it's time to replace their roof. They're like, holy cow, I'm not getting as much as I wanted. So roofs and deductibles, that's #1 in the area. I'll pop in real quick. This one, extended dwelling coverage. So going back to the replacement cost estimation, how much does it cost to rebuild that home once it burns to the ground? The extended dwelling replacement cost endorsement, which we like to recommend, would increase this home amount by 25–50%. It adds on a little bit to the policy, but what it does is acts like a safety net. And the best explanation I can give on this one is a couple years ago, we had a tornado go through Dallas. It wiped out several homes, blocks of homes. When that happens, all of a sudden, there's going to be a demand on the building material to replace these homes. So once again, that cost goes up. Well, we calculated the home to be at $300,000 full replacement cost. But now with the pressure on the building materials, it's now $325,000. Well, with this endorsement that's already included, it's gonna act as a safety net there. So it's there. It's on our recommended policies, but a lot of times you don't see it on normal basic home policies. But we like to recommend it for those reasons.
If you've never been in a tornado, I was showing the house next door. The tornado came on a vacant lot right next door. It was a new home.
Oh, wow.
And the lights went out. The builder girl ran into a closet.
Holy
I'm looking out, and I had a Tahoe at the time. I was parked, here's the builder. I'm parked right here normally. I parked here. The flag with the builder went straight.
Yeah.
And I usually am in my car early, before meeting, and that would have just, the pole, the flagpole went straight like that into the street, and I moved. I was already inside, but it was. And
That's
then as
scary.
I left that building, it was down in the ground.
Down, yeah.
Fire trucks were everywhere. It was
That's
downtown. I was
well,
at Knox.
Tornadoes and downbursts we've seen cause a lot of damage. It's not an actual tornado, but the downburst
You think it won't
causes
happen.
straight line winds cause a tree to collapse on your home. We have it all here, except for the hurricanes. That's what we have in North Texas, and that's another reason why wind and hail deductibles are so important, because when that happens, you want all the money you can get back from the insurance. The second most common claim we see in the North Texas area is water damage. So water sudden and accidental damage. This is when a pipe breaks, not by freezing, but in just a normal, the pipe fails and causes sudden discharge of water and causes damage everywhere. That's built into the policy, as we mentioned before, even the basic home policy. Where we differ and go into the recommended are the water seepage, water backup, and water foundation. And a brief description on these, water seepage and leakage. This coverage will be, let's say there's a pipe behind a wall that has a slow leak. Could be a drip, but over time, it collects and collects and collects and causes damage. Well, you don't know there's a leak, you can't see the leak, but all of a sudden your drywall is messed up. If you do not have this coverage included on your home policy, you're going to be paying out of pocket. It's not included with the home. So water backup, sewers and drains. Pretty self-explanatory. If sinks or toilets are backing up and causes damage, you'll have coverage there. Where if you had a basic policy and didn't include this, you would have to pay out of pocket. Had an example last fall. Had a client, him and his wife, left town for the weekend, didn't know one of their toilets was running, and they came back and there was water everywhere. They had to replace the flooring in 2 bedrooms and some drywall in those bedrooms as well. Cost somewhere in the neighborhood of around $25,000. They had this coverage, so they were fine. If they didn't, they would have to be paying this out of pocket. Next one would be water foundation coverage. This one's a little bit trickier. Not a lot of carriers offer it, but it's like a slab leak type deal. If a pipe breaks and you got to break up the foundation to get to a pipe, you will want this coverage in place. It does not cover the normal shifting of our soils. So we hear about our clay soils expanding and contracting. That's considered earth movement and would not be included on this home policy unless you included earth movement, earthquake coverage. So that's usually a shocker when people go, well, I had foundation coverage. And it's like, not unless you had earthquakes. So something to kind of keep your eye out and look out there for the waters.
If one of our agents goes on a listing and the seller, oh yeah, we just had to rebuild, it caught fire 3 years ago. I mean, that's gonna be water claim, with a bunch of water on it. So that would almost kind of trigger them calling you and go, hey, can we do a clue and see what this is on?
Well, we would run a clue, and in a situation like that, if the home was completely rebuilt, we shouldn't see too many issues. But if it didn't completely burn to the ground, but a portion did, and it was rebuilt, you're probably going to see some pushback on carriers going, we're not interested.
Yeah.
And then that's where, a broker like me, it comes in and is a benefit for you, because I've got option 2, 3, 4, 5, 6, 7, 8, 9, 10 right behind that, ready to go to get you to the finish line to get this closing. Then when that claim turns 5+ years, probably not going to see it, and we can reshop to find better rates, better carriers for you there. Flood coverage. Flood coverage is not included on a home policy. So people get confused when we talk about water damage and water coverages. They go, well, that includes flood. It does not. Flood policy is a completely different policy that goes along with a home policy in a sense. Here in North Texas, we're really not going to see that kind of picture like Houston or somewhere where neighborhoods are underwater. But what we do see is,
We're having in Kentucky right now. We see
I did hear about that.
But Alan, on the south side of the market,
You could,
you do.
Yeah.
So in the Oak Cliff,
Mhm.
and so I know we're in a drought right now, but in the South Dallas part,
It's low-lying
it's
areas.
a lot bigger risk.
Yeah, low-lying
It's
areas.
something to consider. Yeah.
Yeah, in this particular drought,
Mhm.
it could happen up here.
Absolutely.
Because the ground is not gonna
It's
be able
not.
to absorb that much water at
Right.
a given rate.
Yeah.
So it could cause a
Flash
surge
flood.
or flash flood.
So,
It's
so-
coming.
so what I'm saying is, it's not the most common, but it can happen. And what we see here, usually in the North Texas area, is when we get, like, if it's dry and it can't absorb that water, we get a heavy rainstorm that lasts 2 or 3 or 4 days. If you don't have an area that can that's sloping, that drains, and that standing water causes damage, it will be considered flood damage. And if you don't have a flood policy in place, you're paying out of pocket. Also, another one that not a lot of people know, if the city water line breaks, if a water line breaks and all that rushing water comes in and damages your home, that's considered flood insurance. Now, you might have a pretty good case to go back against the city, but for home insurance, the home insurance is not going to cover it, but a flood policy will. So
And that's a separate policy.
it is a separate policy. Yes, ma'am.
Good question.
Question.
So if I called you and said, hey, man, I want a flood policy
Mhm.
right now.
No, so that's a great question because there is a 30-day wait because a lot of people, and it's really more trained for like why they started putting this place is because people on the coast going, oh my God, a hurricane's coming
Here
in
we
8
go.
days. I need flood insurance right now. Hurricane passes.
$30 right now?
Yeah, hurricane passes and then they cancel the policy. So it's so they'll go, sure, we'll give you a home insurance policy, but it's going to be a 30-day wait. Now, some homes that if they are, let's say, located in the south section of Dallas, that are in lower areas and floodplains, you're going to need a flood policy to close with Ryan or Cabot, and that's going to be mandatory. And that's going to be considered in a different flood zone. They can be pretty expensive, but we have ways to look at that. But just so you know, I mean, if it's in a flood zone other than X, you're probably going to need a flood policy, and they'll definitely let y'all know. Then y'all let me know. So,
What are they range from?
so flood zone X, it's everybody's considered in a flood zone. Everybody. Now, they vary in different degrees. The most standard that's not really subject to flood is going to be flood zone X. Typically for a home, let's say around $250,000 in value, it's probably going to be somewhere around $500, $550 per year. So not a super expensive policy.
Most of the homes are going for like 500.
Yeah. That's when it gets a little bit trickier because if you're part of the National Flood Insurance Program, they have a set limit. They will not go above $250,000. We have other carriers that will, but that will increase the rate. But a flood zone X, 500,000, you up to 700 maybe.
Yeah.
I mean, that's a ballpark figure. They're not expensive. Now, if you're in flood zone AE, which is like a Houston area or low lying, $6,000, $7,000 per year.
Wow.
Mhm. Yeah.
But you want it.
What's that?
You want it.
You want it. Well, if you're in a low lying area, you want it because there's a high probability.
Like my sister watches her pool rise. They're going, oh,
Yeah, I would.
get the sun
I would.
out.
Yeah, exactly.
Glad that's your problem, not mine.
And if you live in a home or in a zone like that and you're closing a home, they're going to require it.
Yeah.
Yeah. And they'll build it into your escrow. Now, one thing about a closing on flood insurance, if you are escrowing and it is for a home closing, it can be active right away at the closing day. There's not a 30-day wait. This is just, hey, I feel like I need flood insurance. Okay, that's fine, but there's going to be a 30-day wait. Once we issue it, there's a 30-day wait for it to actually take effect. So,
Alan?
Yeah.
Last question.
Yeah. I love your questions, bro.
Well, because I-
This is Kevin, my brother.
Because I also live on a creek.
Yeah.
And so, talking about like experience homeowning yourself, the 100-year on the
Floodplain.
survey,
Mhm.
100-year, can you talk that?
I mean, I'm not an expert on the 100-year floodplain and what is the zoning requirements, but you're in a flood zone X.
Well, I guess my point is just from experience buying like a house that's on a creek. There's a 100-year line on the survey. And if it's kind of one of those judgments, right? And like mine, where my property is, I'm 30 feet kind of uphill, I'm okay. But if you buy a house and the flood, my neighbor 3 doors down, the floodplain is right next to the house. Right? And so it's just the way,
Strongly recommend
the way
flood
the
insurance.
street that I live on, so you can strongly recommend, like, look, and you can be a value added to your customer.
Mhm.
To be smart like that and say, let's look at the survey real quick. And if it's, if you live in Plano, you're probably not in a floodplain. If you live where I live, I'm in a floodplain, but it only, the 100-year flood
Uh-huh.
is what they call it, something like that. You know, it's low risk to me, but 3 doors down is like, they need to buy the insurance.
Yeah.
I probably don't, but they do.
And the property.
If I say anything wrong, correct me.
Well,
You're the
well,
expert, but-
the one correction I would say is
Yeah.
that everybody's in a flood zone. Everybody, every single home in
Even in
Texas,
Lubbock?
even in Lubbock. And it's so flat there that water doesn't drain. It just rises.
It's the only place in America you can watch your dog on the way for 2 weeks.
That's right.
Yeah.
Come right back to you.
And also, you know, this is measuring risk. This is what insurance is. This is measuring risk and how much do you want to take on? You know, these are all factors. I'm going to recommend flood coverage, recommended policy all day long. But at the end of the day, it's up to you or your client to decide if they want to take that coverage on and kind of gamble with the risk. Not unless it's part of the closing, then we're going to have to do it. So that's kind of the nutshell of the homeowners policy and going through it. There's a lot of homeowners policies that I briefly kind of want to go over because I'm watching the text chain on DHS and I don't want to jump in and muddy the waters or anything, but I do see sometimes questions about renters insurance. That's a really easy coverage. All you're really looking for is how much personal property do you want, and how much liability coverage costs. If you're paying over $150 a year for renters insurance, you need to shop it around because we can probably find something else.
And I think where we see it a lot is in a seller temporary lease. So you're gonna have a seller turn into a tenant. And right in the lease, it says consult your insurance. And
Exactly
we
right.
forget half the time. I forget the tenant, the seller, he doesn't remember. He just got money from his closing.
Right.
The new buyer just never bought a home. They don't know.
They don't know.
And now they're in it a couple days and the seller misses the third step on the attic, taking their Christmas shit out of the attic and
Uh-huh.
become paralyzed. Now we don't know
Yeah.
really who has insurance.
And
on
who
it.
has the liability?
Yeah.
Where's the liability coverage? That would be on the homeowner at that point
No,
in
I
time.
know.
But yeah.
But wouldn't the homeowner need, the new buyer, who's a
Yeah.
landlord,
Mhm.
would have needed to tell their insurance company, I've got a tenant in there for 3 days.
Yeah.
For
Well,
a certain coverage?
you would need landlord insurance.
Exactly.
Yeah, which is completely different. And I have a client right now. We just did it. She sold her home, but had a buyback or a lease back where she stayed in it for 60 days. So we had to get her a renter's policy. And then she bought the new home, but they had a lease back
Yeah.
too. So we had to get her a landlord policy. And then now that she's out of her old home, so she's done with the renters, they've moved out of her new home. So we had to cancel all that and then issue a regular homeowner's policy. And in those steps, if we didn't get these policies and something happened, it may not be covered. So it gets real tricky when we start getting the lease backs. And lease backs, I'm glad you mentioned that, Doug, because they're getting more and more and more common.
Absolutely.
And just kind of a rule of thumb with a lease back, most carriers are going to give you about 30 days to do a lease back. Some carriers are 15 days, some not at all. But if it gets over that 30-day mark,
Too much risk.
it's too much risk and we need to get a landlord policy in there. So it gets tricky, but we've done it
They're
enough.
only doing 60 days, aren't they, Kevin? I think.
Yeah.
Lease backs are 60 days now.
It's a
60
90-day
days,
lease
yeah.
back, but.
Yeah.
renters are only
I've seen
doing 60.
90 days. And I'm like, what are we doing?
Times
You're
are
making my life crazy.
Times are different.
Yeah. So, but then, so that's a landlord policy. If you own the home and there's somebody in there, your standard homeowner's policy could cover it, but you're giving the carrier a lot of leadway to not cover a claim. Where a landlord policy is designed for this structure. Condominium insurance. If you have a client that's buying condominium insurance, they don't want a homeowner's policy. They want a HO6 condominium policy, which pretty much means studs in coverage. So from the walls in, they're usually going to be a master policy with the condominium that will cover the roof and the substructures and the outside of the building. Where your tent or where your client owns the condominium is typically within
Their area.
the walls of that house. So they own the kitchen and the bathrooms and anything like that that happens, you'll want the insurance to cover. Now, but we want to make sure there is a master policy with the building. Yeah, with the building. This goes with townhomes too. Sometimes there is not really with townhomes. Sometimes there's not a master policy. So we have to look up a regular homeowner's policy, but that's just half the side of the home. Some carriers want all sides of the homes to be part of that calculation. So there's actually 2 kitchens. There's, if there's 2 bathrooms on one side, I'm having to input 4 bathrooms total for that whole structure. So depending on the type of home or what they're buying, there's going to be an insurance policy for them. Manufactured home, mobile homes will have coverage for you. And farm and ranch. Whenever you start getting, I've worked on a couple of deals where they've had enough acreage to where they've had cattle on the property. Well, then we have to ask questions of, is this a commercial type business or is this just a hobby? And then through that, we can figure out, well, do we stay with the homeowner's policy or we need to move to a farm and ranch type policy? So
Like on cattle,
Mhm.
if it was commercial and the cattle got some type of a bug, they killed 20 of them, are the cattle actually insured as part of that policy?
that's going to be built into that
I
farm
never
and
know.
ranch. Yeah, it's going to be built into that
They have a
because
dollar value.
they have a dollar value because it's really commercial operations now.
Yeah.
And we're going to switch you over to a commercial policy
Okay.
that includes your home on the ranch. So it
Like
gets,
raising the cattle.
and that if they have chickens, or goats or anything, up to a certain number, they'll allow for some carriers, some won't allow it at all. But it's just really kind of getting as much information that I can from the clients. And this is my job. So that's why,
But here,
you don't know these traps that I see, that I go through every day. So whenever you have a client buying a home, that's why it's beneficial just to send it over, and I'll be in communication if anything happens, but I see this more than you guys do. And what you want to send it over to. So one thing before we kind of get into closing, Doug mentioned about the escrow process. And I can bring these guys in over here. So when we issue a policy, I've had questions before. Oh my gosh, this is a lot of money. Why do I have to pay this out of pocket right away? And I'm like, no, not at all. Well, it's going to be part of probably your closing costs, but that's when you got to talk to these guys over here. So it's going to be built in, and whenever you close with insurance and it's an escrow, it's going to be paid for the full year. And then through the months of your escrow payments, you're pretty much building the insurance payment when it renews that will take effect next year. So when the home policy renews, you already have the amount in escrow to pay for that policy in full, and we rinse and repeat and start the process. So your monthly payments will be paying for the future insurance is a way to look at it.
Does everybody understand what he's talking about?
It went on.
Well, if you're, let's
Well,
just say,
we're at closing
Yeah,
here,
you're
so
Okay.
so let's just say hypothetically that your insurance was $1,200 for a year premium. At closing, your buyer will be debited $1,200. If you divide it 1,200 by 12 months, it's $100 a month. The day they make their first payment, $100 will come out. That means when they make their 12th payment, it's the anniversary of their closing date, and it'll be another 1-year premium that's paid another year in advance. So every time you own a home, even your payments each month are calculating 1/12 of your yearly premium to put in an imaginary savings account that you don't have any withdrawal rights on, that just builds, and then after 12/12s, it's paid a year in advance. Which
Yeah.
means that when you go on a listing, Tim, and you ask your seller, hey, what month did you close? And they go, oh, the end of July. Well, you know that we are just finishing the end of July, so we just got paid a whole year in advance. Their insurance, they're gonna get a refund of that amount, plus usually a couple months reserves. So they're gonna get about 14 months after closing, about 4 weeks later. Make sense?
yeah, no, that's perfect. That's exactly, and that's important on what you guys need to know with insurance. And an also kind of thing to know with insurance, you can cancel it at any time. You pay, you start insurance day 1, you could cancel it day 10. But you want to make sure you have other insurance in place before you cancel it. But the reason I say this, you have the power to cancel your insurance at any time. The insurance company also has the power to cancel the policy as well, but they have to give you a 30-day notice
It's like
to go find
broker.
new insurance.
So, I have a question. So let's say now I want to cancel my insurance in my house and I want to get one with you. I can call my insurance and
Mhm.
let them know that
Yep.
I'm just cancel.
Yep, you can cancel now. Where it gets tricky is if you're in escrow, we would escrow the new insurance to your lender and then cancel your current policy. You would get a refund from that old policy that you need to get back to them, to your lender, so they can square out the books because they're
And
paying for
possibly
this.
your payment could go down
Yeah.
in about a year. And they recalculate your escrow and go, oh, your old firm was charging $1,200 a year. That was $100. And hypothetically, let's say he was doing 1,000. Well, that's about $80.
Yeah.
And so now your payment's gonna go down by $40, but it might take about a year to,
And that's-
calculate it.
and that's-
What
and
Alan
that's-
does great is he won't take your business if he thinks your business is better.
Exactly. Like
And that's the same with Brooks and Kevin and
Yeah,
Ryan.
if-
Like, if they can't beat another lender, they're not gonna tell you to go with them just because they're with them.
and really there's no point to piggyback on that. There's no point to, because insurance carriers are going to rate you on how long you stay with one company. So if you jump year to year to year to year to year, they're going to charge you like they only have 1 year. And so they're not going to give you the best deal they can offer. If you've been with a carrier for 10 years, they're like, wow, we're going to have 10 years with this client. Let's get them a better rate.
So you should take a look at my current policy to look at it to see.
Sure. And kind of,
Pat, this is good, or Pat, you're getting screwed.
yeah, exactly. Or if you're on an HOA policy and you're like, ooh, that's not a very good policy.
What do you do about, like, with my insurance? I got my homeowners, I got my universal.
Sure. Well,
Universal life policies, I've got umbrella.
I do home, auto, and umbrella. I'm not in the life insurance
Life.
game,
They don't even what we.
That's
they don't
health and
even
life,
Sell
but-
it anymore. I mean, it's.
but I get a lot of clients that go, hey, here's my home, here's my auto, and here's my umbrella policy. Shopping. And I'll go and shop everything and I'll take a look and I can say, hey, here's my options that are giving the exact same coverage with maybe a lower rate. Or I can go, hey, you've got a great policy, stay right where you're at, because next year when it renews, we're probably going to see an increase and we can reshop it.
So you don't do long-term either.
And what,
Long-term health.
no, I'm just personal and commercial. I
So
don't
I
do health.
probably should call you because I have other questions too
Yeah.
that relate to my. particular
Well, and we
situation.
can get to the questions. A few last things.
Yeah.
What I've seen kind of realtors make a mistake on
Mhm.
when they're talking about insurance and closing is being too involved.
Mm.
Trying
I
to,
don't know anything.
but trying to negotiate rates and really it's you need to let me talk to the client and have that conversation, because
That's what you do.
and also if you recommend a policy and go, no, you need to go with this policy because it has the lower rate, and then something happens, you could be held liable. I know we have errors and omission insurance, because if we say we're going to cover something and it doesn't happen, we could be sued. And so that would be the same, potentially. Thanks.
Oh,
Yeah.
My next question was, what kind of process do we put you? Like as soon as they.
As soon as it's application, that's when you want me to get involved, because I might have some information that pops up in a clue report that may affect that option period of them backing out. It's just, and you don't want to wait too long, because that insurance could also sabotage it. It could raise, and then the debt to income is too much, and then everybody has to walk away. That's what yes.
You saw, going back to the pool, people who own pools, okay?
What's that?
Say it again.
I own a pool.
Mhm.
On a
So
pool?
you said, swimming. So you said that you're liable if something happens to someone.
Mhm.
What if you have a sign out there that says you're not liable if something happens to them?
It's,
You're not covered
Get a lock.
anyway?
yeah,
What?
You need a lock on the gate.
No, I have a lock.
Oh,
but I mean,
No,
that's,
I'm saying inside, like your guests come and they get hurt.
if you have a sign, I mean, that, depends on the lawyer that's coming after you. They may say that sign's not good enough,
You
and
know, the sign will protect you from anything.
that'd be more of a
The sign
legal
away.
attorney question. And that's where, for you, with a pool, I would definitely recommend your max limit on liability and potentially an umbrella policy, which is an additional liability coverage to protect you. I've heard stories where, back when I was a kid, pool hopping. Anybody pool hopping?
No, I never.
Never did it? Late at night, jumping into other people's neighbors' pools. If somebody were to jump in your pool late at night and got injured, you could still be held liable.
Because I don't think my insurance knows that. I guess it should know that I have a swimming pool. Huh?
You should, yeah. And that's where, my three main questions when I ask a client,
Never came into the questions. I brought them.
yeah, and that's my three main questions when I first ask. Do you have a pool? Do you have a trampoline? Because trampolines are a liability. Do you have any dogs? Do you have any dogs that are pit bulls or chows? And then age of the roof. These are all factors that are underwriting questions that can either sabotage the deal or, go ahead, or cause your rates to be exponentially higher.
I have a question. Do you have Spanish speakers?
I do not. No, sorry.
I'm asking because my clients all.
I'll speak Spanish, yeah.